Ah, the unsung guardian of a nation's economy, foreign reserves. These reserves are like the silent sentinels that stand guard over the financial stability of a country, ensuring that it can weather economic storms and uncertainties. These are essentially a country's financial safety net, assets held by the central bank, often in foreign currencies. They act as a buffer, providing the necessary liquidity to manage the country's international financial obligations and to stabilize the national currency. Think of them as a national savings account. Just like how individuals save money for emergencies or future needs, countries accumulate foreign reserves to safeguard their economies against potential crises. For the Philippines, the Bangko Sentral ng Pilipinas manages these vital funds. This institution plays a crucial role in maintaining the country's economic stability by carefully monitoring and managing these reserves. These reserves include foreign currencies like the US dollar, gold, and other internationally accepted assets. The diversity of these assets helps in mitigating risks associated with currency fluctuations and economic downturns. Their careful management is key to economic health, providing a buffer against unexpected global events. Whether it's a sudden spike in oil prices, a financial crisis, or geopolitical tensions, having substantial foreign reserves allows the country to respond effectively. The Philippines needs foreign reserves for a multitude of reasons. They are essential for maintaining investor confidence, which in turn attracts foreign investments and promotes economic growth. A primary use is to pay for imports, including oil, machinery, and consumer products. These imports are crucial for the country's development and day-to-day functioning, making foreign reserves indispensable. They also help the government and businesses service their foreign debts. By ensuring that there are enough reserves to meet these obligations, the country can avoid defaulting on its loans, which would have severe economic repercussions. Foreign reserves also play a key role in currency stability. By intervening in the foreign exchange market, the central bank can influence the value of the national currency, helping to prevent excessive volatility. This ultimately benefits all citizens by fostering a more predictable economic environment. A stable currency means stable prices for goods and services, which is crucial for the well-being of the population and the overall economic health of the nation. Many Asian countries learned hard lessons from past financial crises. The Asian financial crisis of the late 90s was a major turning point. After the crisis, a common strategy emerged where countries across Asia began to build up their foreign reserves significantly. The Philippines has been part of this regional trend, recognizing the importance of a strong reserve buffer to protect its economy from global volatility. The Philippines generally maintains a healthy level, often comparable to or stronger than some peers, reflecting prudent management. Economists use several standard metrics to assess if a country has enough foreign reserves. One of the most common is import cover, which measures how many months of a country's usual imports can be paid for using its existing reserves. The Philippines typically maintains a healthy import cover, often significantly higher than the traditional benchmark of 3 months. Another crucial measure of reserve adequacy relates to a country's short-term external debt, with the Philippines generally performing well on this metric too. Strong foreign reserves are vital for helping a country absorb economic shocks. The global economy is often turbulent, and nations can face sudden challenges. When such shocks occur, foreign reserves can be used to stabilize the currency and ensure that essential imports continue. The Philippines has learned from its historical experiences. A healthy level of foreign reserves has a direct positive impact on a country's sovereign credit ratings. Strong reserves are seen as a key indicator of a country's ability to meet its debt obligations. Furthermore, substantial foreign reserves enhance investor perception and can attract foreign direct investment. A common misunderstanding arises when people look at the Philippines' economy. They often focus on a single aspect, which is the merchandise trade deficit, and overlook the broader picture. Many focus solely on the merchandise trade deficit. This deficit occurs when a country imports more physical goods than it exports, leading to a negative balance in merchandise trade. However, this view is incomplete and can be misleading. The merchandise trade numbers are just one part of a much larger economic picture. To truly understand the economic health of the Philippines, we need to look beyond just the trade of physical goods. We must consider the current account, which provides a more comprehensive view. The current account includes not only the trade in goods, but also trade in services, primary income, and secondary income. These components together give a fuller picture of the country's economic interactions with the rest of the world. The Philippines' current account position often tells a more positive story. While the country may have a deficit in its trade of goods, it typically enjoys substantial surpluses in other areas. For instance, the Philippines has a robust service sector, including business process outsourcing and call centers, which generate significant revenue. Additionally, remittances from Filipinos working abroad contribute greatly to the economy. Consistent BOP surpluses, driven by strong service exports and remittances, are a key reason for the Philippines' healthy reserve levels. These surpluses help stabilize the economy and provide a buffer against external shocks, ensuring long-term economic resilience. The contribution of overseas Filipino workers, or OFWs, to the Philippine economy is immense. Millions of Filipinos work abroad in various professions. They send a significant portion of their earnings back home to support their families. These funds, known as remittances, are a cornerstone of the Philippine economy. Remittances directly contribute to the supply of foreign exchange in the Philippines. One remarkable characteristic of remittance flows to the Philippines is their stability and resilience. The impact of remittances extends far beyond just bolstering foreign reserves. They contribute to a healthier balance of payments, strengthening the peso and helping maintain the robust reserve position. The rise of the business process outsourcing, or BPO, sector in the Philippines has been a remarkable economic success story. This industry has grown rapidly over the past 2 decades. The Philippines has become a leading global destination for these services. This sector is a powerhouse for earning foreign currency. Revenues generated by the BPO industry are classified as service exports. The consistent growth of the BPO sector has provided a significant and reliable stream of income. Beyond BPO, other service exports also contribute to the Philippines' foreign exchange earnings. The growing contribution of the services sector is vital for a more resilient current account and balance of payments. The Bangko Sentral ng Pilipinas, or BSP, the central bank of the Philippines, plays a central role in managing the nation's economy. Established in 1993, the BSP has been pivotal in steering the country through various economic challenges and opportunities. Its influence extends across multiple facets of the financial system, ensuring that the economy remains robust and resilient. Its primary mandates include maintaining price stability, ensuring financial stability, and overseeing an efficient payments and settlement system. These mandates are crucial for fostering a stable economic environment where businesses can thrive and consumers can have confidence in the value of their money. The BSP is the custodian of these reserves. This means it holds and manages the country's foreign exchange reserves, which are essential for safeguarding the economy against external shocks. These reserves act as a buffer, providing the country with the means to manage exchange rate volatility and meet international financial obligations. It makes strategic decisions about how they are accumulated, invested, and utilized. The BSP's investment strategies are designed to maximize returns while ensuring that the reserves remain liquid and secure. This careful management helps to maintain the country's creditworthiness and investor confidence. The BSP employs various monetary policy tools that can indirectly influence the level of foreign reserves. These tools include interest rate adjustments, open market operations, and other measures that help control inflation and stabilize the currency. The BSP also conducts foreign exchange operations. By buying and selling foreign currencies, the BSP can influence the exchange rate and manage the supply of money in the economy. These operations are vital for maintaining the balance of payments and ensuring that the country can meet its international financial commitments. Beyond accumulation, the BSP follows prudent strategies for managing the existing stock of reserves. This includes regular assessments of the global economic environment and adjustments to the investment portfolio to mitigate risks and enhance returns. This proactive and cautious approach to building and managing buffers has been instrumental in establishing the Philippines' strong external position today. By maintaining a healthy level of reserves, the BSP ensures that the country is well prepared to face any economic uncertainties and continue on a path of sustainable growth. The Philippines currently enjoys a strong foreign reserve position. This is a significant achievement. It reflects the diverse and resilient sources of foreign exchange that the country has cultivated. However, it is also important to acknowledge the persistent challenge of the merchandise trade deficit. Strengthening the export sector for physical goods is a key long-term goal. The long-term vision for the Philippine economy should include a more balanced external sector. In conclusion, the Philippines' substantial foreign reserves provide a crucial foundation of stability in an often uncertain global economic landscape. While celebrating these strengths, the nation must also continue its efforts to improve its merchandise trade balance.